Hello, Mark here from Success with Options. Welcome to part 2 of the calendar spread tutorial. In part 1, I went over the basics of calendar spreads and quickly jumped into setting up the trade. When we left off, I was going through the process of using the theoretical pricing tool on the Thinkorswim platform to estimate the potential future value of our spread if time moved forward to the Monday before expiration and our stock moved down to $4.94. What we can do is because we have chosen as one of our columns to be the theoretical price, we have a couple of fields that open up to us. What I'm going to do is I'm going to type in, let's just call it around 5. Okay, so the price is to move down $5. If the price was to move down $5 and no time passed, we can see that we've already made potentially some money in the trade. We entered the trade at $1.30 and it's now worth $1.57. So that's a potential profit of 28 cents. So now let's move time forward a little bit, and we will move to look at the Monday before expiration. We see that the value of this option is now $2.04. So now we entered the trade for $1.30. And we have potentially 70 cents of profit on this trade. Now the thing I want to point out here is that what we've analyzed is potentially the best case scenario. Actually, there's one more thing we can evaluate, which is if the stock dropped down, we might expect that volatility will jump by a little bit. So if I increase the volatility by 2%, we can see that we just picked up another 16 cents or so worth of credit in being able to close that position. So again, the way we would calculate the profitability is that we bought that spread for $1.30, or we're looking at buying that spread for $1.30 today, and if in a week and a half, on the 15th, we can close that position and the price moved down about $5 and volatility moved up about 2%, we could close that position for $2.16. Now that's not a guarantee, but it is a good way to estimate. Now, the thing that I would typically do is I would maybe take a look at the possibility that we're not going to move down all the way to $90. So let's be a little more realistic and say we'll move down $3 over the course of time, and let's say that volatility only increases 1%. Now we're looking at $1.98. So we're still looking at a trade that could return us about 67 cents on a $1.20, $1.30 investment. So not too bad of a trade. Now the next thing we need to do is think about, again, how that affects our current position that we entered relative to the fact that we put it in as a 2-month trade versus a 1-month trade. Remember, the cost of the trade to enter for a 1 month was $1.30, whereas the cost to enter the 2-month trade was about $2.50. Well, what we can do is realize that this is our potential closing value, or it could be our potential rolling value. So what we need to do is think about doubling this value. So in this case, we'd be looking to potentially make as much as $4 on a 2-month trade that costs us $2 to enter. So that would be $2.50 to enter. So that would give us about $1.50 of profit on a $2.50 entry on the trade. So either way, we're still looking at a pretty decent return on this position, and so we're going to go ahead and consider this as a 2-month trade. So what I'll do is we'll scroll down to we closed our order. Let's open it back up. We still have our position here. We're looking at our 2-month trade. The cost to enter has gone up a little bit. I suspect that's because the stock has changed in value a little bit, perhaps moved up or down. But we'll go ahead and set this trade up. Now the thing we need to figure out is, now that we know what our cost to enter is, $2.55, we need to figure out how many contracts we can enter. We have a portfolio of $20,000 that we're willing to risk, say, about 2%. That'll be about $400. If you remember, the cost of one contract for the calendar was $2.55. So how many contracts can we purchase? Well, it's $400 divided by 255, or 1.56 contracts. Since we can't take fractional contracts, we'll have to go with one contract. Okay, so we know that we can take one contract of this position, so we'll go ahead and set the trade up. We've already got the one contract entered, and all we need to do then is enter, confirm, and send. And we'll see that the trade filled. Now what I want to do is go over and take a look at our monitor tab really quickly. And what we see is we have our current trade that we just put in for the SPY. We still have the trade that we put on for the vertical spread, the EWZ. We won't pay attention to that for the moment. But I wanted to draw your attention again to a couple of the columns in for the SPY. Notice that we have a negative delta for the SPY position. Why would that be? Well, if you think about it for a moment, we have a position that actually would profit by a move down in the price of SPY. Therefore, we have a negative delta. We also have a positive theta, which means we still have a position that's going to benefit from the passage of time. And we also have a position that has positive vega, which means that if volatility increases, we'll actually make money on that position. Now, the other interesting thing that I want to draw your attention to is what are the aggregate totals of everything that we have in our two positions. This is a slight deviation from the calendar spread, but it's important to realize that one position does have an impact on another position. So the net effect of these two positions that we have on, a bullish position on EWZ that's a vertical spread, and a bearish, slightly bearish position we have on the SPY, leaves us with a slight negative bias in the delta, additional theta, so we have virtually twice as much theta eroding away, and we have a net vega of 9, which means that we have a stronger desire to see volatility increase than decrease. So that's our overall position. Now let's talk a little bit about trade management on this position. This is not quite so easy of a position as we talked about with the vertical spread, where we could simply say, well, let's exit when the price reaches X. We have a couple of things that we want to monitor for. We entered the trade for $2.55, and we're looking, because it's a 2-month calendar, we're looking at, in the ideal case, to find an opportunity to benefit when the stock moves down to close to $90. With about 14 days left till expiration on the June option, we're also considering when would be our best opportunity to roll from June to July. So this is a bit of a moving target, and it's kind of difficult to actually come up with an exact number. But basically what we're looking at is if we see any pullback over the next, I would say the next week or so, that would take us down into the $90 range, I would look for an opportunity to potentially do a roll from June to July. If we see time continue to pass and virtually no changes, and we see a continuation of the move up, and we pass through or get very close to the June expiration, and we haven't seen our expected move down, I would probably consider just closing the trade and capturing whatever remaining value there is. And it could be a very, very likely chance that we would see the majority of that value be returned to us. In fact, it's actually possible to see this stock not go the way we expect and have it make money. Maybe not a lot of money, but we could actually close that for let's say, instead of $2.55, we might be able to close that for $2.60. Why would that be? Well, think about our position again, where we go back to this SPY and we look at the individual components. We see that our August position is worth $3.15, and our June 90 put is worth about 59 cents, 59.50. Well, if we don't come anywhere close to $90, if we remain at the same point we are, and time passes, we'll see the $90 put erode to virtually zero by expiration, whereas we may see only 20, 30 cents of erosion on our August 90 put, because there's still pretty much 2 months of time value, and it's purely time value at this point on that position. So that's one of the advantages that we see with the calendar spread is there's an awful lot of forgiveness in that position in allowing us to be wrong and still make a little bit of money, or at least not lose a lot of money. So it's kind of an interesting position from that perspective. I hope you found this video helpful. What you've just seen is an overview of calendar spreads as a trading strategy and an example of trading them. Successful options trading is not just a matter of knowing how to construct a trade or how to enter or exit the trade. Successful options trading is built around a trading system that includes a trading plan with rules for selecting the stock or ETF, rules for selecting the options, rules for entry and exit, and rules for money management. These elements help produce consistency, and that is the #1 attribute of a successful options trader. For more information on options strategies, building an options trading system, or options broker reviews, and more, please visit www.successwithoptions.com. Thanks and happy trading.